First, we need to understand how economy operates. The economy function like a basic machine. It composed of simple parts and transactions that are repeated countless times. However, many individuals either do not comprehend it or disagreeing of its working. It operates in a straightforward mechanical manner. It comprises a few basic elements and numerous transactions that occur repeatedly. These transactions, primarily driven by the human nature, creates three main forces that propels the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We explore these forces now and how layering them to provide a solid foundation for understanding economic trends and current situation. Let's start with the more basic aspects of the economy, like transactions. Our economy is essentially the sum of all its transactions, which are straightforward events. Transactions occur wherever a buyer exchanges money or credit with a seller for goods, services, or financial assets. Credit functions like money. So when we combine money and credit spent, we obtain the total spending, which drives the economy. Dividing the amount spent by a quantity sold or give us the price, this is a transaction. It's the fundamental building block of economic machine. Our economic cycle and the forces are driven by transactions. Therefore, understanding transactions provides insights into the entire economy. A market consists of all buyers and sellers' transactions for the same item, wherever it's wheat, car, stocks, or millions of other things. An economy encompasses all transactions across its market. But totaling the spending and quantity sold in all the markets, we gain a comprehensive understanding of the economy. Individual, businesses, banks, governance engage in the transaction by exchanging the money and credit for goods, services, and financial assets. The most significant buyer and seller is the government, comprising a central government that collects the taxes and spends money, along with a central bank that controls the money and credit supply by influencing the interest rate and printing the new money. For these reasons, as we'll see, that central bank plays a crucial role in the flow of credit. Pay close attention to the credit because it is most important, yes, least understood aspect of the economy. It is crucial because it's the largest and most volatile part. Similar to buyer and seller making transactions, lenders and borrowers also engage in transactions. Lenders typically seek to increase their wealth, while borrowers may desire to purchase something that cannot afford, such a house or car, or invest in ventures like starting a business. Credit facilities, both lenders and borrowers, is achieving through their goal. Borrowers commits to repay the borrowed amount, called the principals, and plus interest. When interest rates are low, borrowing increases at it's become cheaper, while high rates discourage borrowing due to the expenses. When borrowers commit to repay and lenders trust them, credit is created. Essentially, any two parties can agree to create credit out of thin air. However, credit is complex because it is transforms into debt as soon as it is created. Debt acts as both as an asset for the lender and liability for the borrower. In the future, when borrower repays the loan with interest, the asset and liability vanishes and settling the transactions. So why is the credit so vital? When a borrower receives credit, they increase their spending, which, as mentioned earlier, drives the economy. Increased spending from one person becomes another person's income. Therefore, when one spends more, someone else earns more. Rising income makes lenders more willing to lend, as the borrower now appears more creditworthy due to the increased income and assets serving as collaterals. This self-enforcing cycle leads to economic growth and explain why cycles exist. In a transaction, sometimes must be given to receive, and what is received depends on a productivity. Over time, productivity growth accumulates knowledge, improving the living standards, and we call this productivity as growth. While those who are innovative and hardworking sees faster productivity and living standard increases, this isn't always immediate. Productivity is crucial in the long run, while credit matters most in the short run. Productivity growth is relatively stable and not a major fraction of economic fluctuations, unlike debt, which enables consumptions exceeding the production during acquisitions and demands spending below production during repayment. The ups and downs in the economy are primarily due to the credit rather than innovation or hard work. In an economy with credit, spending increases not just from income growth but also from borrowing, allowing for faster income rises than productivity in the short run, though it's not in the long run. However, credit isn't inherently bad. It becomes problematic when it funds unsustainable consumptions. Efficient credit allocation can lead to increased income and improving the living standards. For instance, borrowing for a TV doesn't guarantee income, but borrowing for a tractor increases crop yield and income, facilitating debt repayment and standard of living improves. An example, if you earn 1 lakh annually and borrow 10,000 on a credit card, your spending rises 1,10,000 despite earning of 1 lakh. This 10,000 spending become another person's income, who can then borrow 11,000. Continuing the cycle, this self-reinforcing pattern characterizes economic growth, with one person's spending become another person's income. However, borrowing creates cycles. Needing highs and lows, the short-term debt cycle initiates economic expansion and spending and pricing rise due to increased credit availability. Inflation prompts the central bank to raise their interest rates, decreasing borrowing and spending. For our case, it is repo, mostly controlled by RBI, you all know that. This leads to decreased income, reduced spending, and a recession leads. The contract to this is the central bank lowers its interest rate to stimulate the borrowing and spending in the cycle and restarting the cycle again. The short-term debt cycle lasts 5 to 10 years time, repeating for decades, with each cycle ending with more growth and debt. However, over time, debt accumulates faster than incomes, creating the long-term debt cycle. Despite rising debt, incomes and asset value rises, offsetting the debt burden, and this leads to a boom as debt increases, fueling the bubble. When debts become unmanageable, the economy deleverages, forcing spending cuts, defaults, wealth redistribution, and money printing. Deleveraging is painful because it causing the recession and depressions. The debt exceeding income, leading to the decreased spending, asset devaluation, and social tension. Over time, debt burdens have become simply too big. For Europe, US, and many of other countries, that much of the rest of the world, that has actually happened in 2008. Fortunately, India escapes. So, welcome to the curriculum. Follow these economic areas. You will definitely do better in your investment journey. Thank you.